Hey everyone! Today we're diving into something every investor needs to keep up with: stock market analysis. Whether you're a beginner or a seasoned investor, understanding how to analyze the stock market can help you make smarter investment decisions. So let's break it down. First, let's start with a quick overview. Stock market analysis is basically a way of assessing the financial health and potential of various stocks to predict future performance. There are two main approaches: fundamental analysis and technical analysis. Fundamental analysis focuses on the overall value of a company, looking at things like revenue, profits, and future growth potential. Technical analysis, on the other hand, looks at stock price trends and trading volumes to try and forecast what the stock price will do in the short term. Let's start with fundamental analysis, which is great for long-term investors. If you're looking to hold onto a stock for years, this is where you'll want to focus. You'll need to check things like the company's financial statements, earnings reports, and key financial ratios. Here are 3 key ratios to look at. Price to earnings, PE, ratio. This shows the price investors are willing to pay for each dollar of earnings. A high PE might mean the stock is overvalued or has high growth expectations, while a low PE could mean it's undervalued. Debt to equity ratio. This ratio measures a company's debt compared to its equity. If a company is heavily indebted, it could be risky, especially if interest rates rise. Return on equity, ROE. ROE tells us how effectively a company uses shareholders' money to generate profits. A high ROE indicates efficient management. Now, for those interested in short-term trading, let's talk about technical analysis. This approach relies on charts and patterns to predict stock price movements. Here are some basic tools and indicators that traders use. Moving averages, like the 50-day or 200-day moving average, show the average price over a set period. When the short-term average crosses above the long-term average, it's often seen as a buy signal, and vice versa. RSI measures whether a stock is overbought or oversold. An RSI over 70 usually means it's overbought, while under 30 could mean it's oversold. These are price levels that a stock tends to struggle to move above, called resistance, or below, called support. Understanding these levels can help you decide when to enter or exit a trade. Alright, let's bring it all together with an example. Let's say you're looking at Apple Inc., AAPL. Here's how you might analyze it. For fundamental analysis, we see Apple has a PE ratio of around insert current PE. This is higher than the industry average, meaning investors expect growth. Now, looking at technical analysis, we can see that Apple's 50-day moving average just crossed below the 200-day, which could indicate a downtrend. See how combining these insights gives you a better picture of what's going on with the stock. Here are a few quick tips if you're just starting out with stock analysis. Start with a few key metrics, rather than trying to understand everything at once. Keep track of both fundamental and technical indicators. They each offer unique insights. Remember that no analysis is foolproof. Make sure to diversify and don't invest more than you're willing to lose. And that's a wrap. I hope this gave you a solid foundation for stock market analysis. Let me know in the comments if you have any questions or want to see more detailed videos on either fundamental or technical analysis. Don't forget to subscribe, like, and share if you found this helpful. See you in the next video, and happy investing.